So, for the weighted average cost of capital, it is very important to understand that WACC could be suitable for projects that are scale enhancing, that is, projects whose cash flows have a direct relationship or correlation to the operating cost of the business. So, we can say that the risks of the overall business has a direct relationship to the risks of the project, to the operating cash flows of the project. So that is exactly when we use WACC to determine the value of a project or to acquire another company. So basically, if you're looking forward to acquiring a company that might be in the same industry with the parent company, then WACC could be a better measure of the value of the company which you want to acquire. However, for the adjusted present value, it could be a better measure if a company is trying to acquire another company from another industry. So we can say that their cash flows are not related to each other, so they operate, they have different measure of risk, and as a result, they have different betas, and that makes the adjusted present value a better measure of the value of the business or the investment which the parent company wishes to acquire. So that's very important for us to understand how adjusted present value in modern finance could be very significant in measuring the value of a business or a particular project. So now let us talk about some other few things here. So it's very important for us to talk about the different kinds of valuation methodologies we're going to be using throughout this model from Haynes. So the methodologies we're going to be using are both primary and secondary. So for the primary valuation method, we have, as we said earlier, the discounted cash flow analysis, which enable us to discount cash flows from the future heavily back into the present date or the transaction closing date. So discounting those cash flows takes into account the WACC. So the WACC, which is a measure of the capital structure, that is the risk invested in issuing bonds or issuing equity. That WACC will be the discount rate that will be applied to discount those cash flows heavily back into the present or the transaction closing date. So it is a very important metrics methodology, and it is widely used across the industry. However, we have other primary methodologies such as we have the comparable company analysis, we have precedent transactions, we have the sum of the parts analysis. So for the comparable company analysis, we take into account companies that are in the same industry or operate in the same line of business to the parent company. So we could estimate the value of a business based on comparable company analysis, where we take into account important metrics such as the EV, we take into account metrics such as the exit multiple. So whatever for example, the EV to EBITDA, which is a very important metrics, or we could use the EV to revenue if it's still a startup company, or we could use for high growth companies EV to EBITDA, and also EV to net profit or EV to the cash flow of the business, depending on this life cycle of the company. So so if the company is operating in a maturity stage, then we could use other methods such as EV to EBITDA as evaluation metrics. as an exit multiple to measure the value of the company. So it's very, very important for us to understand that. And this comparable company analysis, it is highly debated. However, we have other methods to measure the values of a company, such as the precedent transactions we explained a while ago. So for the precedent transactions has to do with past M&A activities. So we take into account M&A. So we take into account M&A, past M&A activities that happen as a result of an acquisition or a merger. So we take important matrices again, just as we use for the comparable company analysis. So we take important matrices such as the revenue, the EBITDA, the net profit, and then we estimate multiples based on those matrices to come up with exactly the EV to EBITDA multiple that could be used for valuation purposes. So as you can see, it's very, very important. So for the sum of the parts analysis, for example, for Amazon, we realize that for Amazon, if we go to our financial statements, we realize that Amazon revenues is based on online stores. We have physical stores, we have retail third-party seller services, we have subscription services, we have Amazon Web Services and other. So as you can see, these are different business segments which we could take into account